Joining us right now is SEC Chairman Paul Atkins, and we welcome him to the broadcast this morning. It was nice to see you in person at this table just a couple of weeks ago. This bill now officially in the books. How does it change things? And how does it change things for you in terms of the assets that you think are going to come into the market that you will ultimately need to regulate in the public sphere, if you will?
Well, thanks, Andrew, and it's great to see you again, and thanks for having me back here again. So I thought this is a really great watershed and thanks to the President for his leadership and the Congress for getting this out and getting that bill to the President's desk for signature. I think this bill the Genius Act is focused on payment stablecoins, and so that's not really within the SEC's ambit of regulation, but it's really for the banking regulators, as is appropriate. But the one great thing about this is that for the first time now, the United States government has put its stamp of approval on a very key and important, potentially very important digital asset that will, I think, help to lower costs, lower risks in the market, because we can now move towards an instantaneous almost settlement of payment versus delivery for securities, thanks to on-chain stablecoins. And that will help, I think, innovation and to really get our markets, to be the best in the world.
What's the role, therefore, of the SEC to push exchanges and all the other financial middlemen effectively to settle basically all transactions at what might be described as T0?
Yeah, well, potentially that's where we're going. Now, there are a lot of things that need to be worked out, and of course, to have some ability there to prevent fraud and in the marketplace, with respect to instantaneous settlement. Those things can be worked out as the marketplace adapts to that potential. But we've seen, and as far as now we're at T+1 settlement, and so of course, again, almost instantaneous delivery versus payment is something that people have dreamt about for many, many decades now.
I mentioned T0. That means effectively instantaneous settlement. T1 means a day, just for those, right. So we can explain it to the audience. Let me ask you a separate question. There was a report last week that has a lot of people buzzing about 401k plans and the possibility of including private companies meaningfully inside of 401k plans. And therefore, what that does to even your job, because historically, one of the reasons that private companies have not been in these plans is that they don't have the same kind of disclosure requirements that a public company does.
Yeah, well, thank you, Andrew. That's a really important point. And so the private markets have really grown a lot over the last, say, 30, 40 years, where used to be primacy of the public markets for companies, including young companies, to try to seek capital for their research and development, to build factories and develop their products. Over the last 4 decades, the private markets have burgeoned, and there's a lot of capital there that provides through venture capital, through private equity, and now private credit more recently, a lot of ability for existing companies and startup companies to tap into all of that capital. There's a big demand from investors, individual investors, to be allowed into those marketplaces. There are a few ways for them to do it now, but the SEC has made it difficult in the past. So what we want to do is work with the Department of Labor, and obviously at the President's direction if and when an executive order comes for that. But regardless, we can work with the Department of Labor to help to have good guardrails for people to offer through various products that are registered for individual investors to put into their retirement plans for long-term investment. We have to remember that these private funds we have issues regarding valuation, issues regarding liquidity, issues regarding fees, and that sort of thing. So we need to make it so that individual investors are relying on fiduciaries to help them put these sorts of products if they wish into their long-term savings and retirement plans, but to have appropriate guardrails around all of that so that people are not hurt in the process.
Philosophical and maybe practical question. If we go down this road, and by the way, there are some mutual funds already that have access or allow public shareholders or public investors have access to private investments, for example, does that mean we think that there will be companies that will stay private for even longer? That's been an issue I know that you've thought about, because I think you want more and more companies to be able to go public. Or does a public and private company and what they look like and the disclosures around them almost converge in some kind of way long term?
Great point. And so who knows? But the thing that I do know is that over the last, say, 30, 40 years, the costs and headaches of being a public company have grown. And the amount of capital on the private side has grown as well, obviously, and searching for good investments. So what I want to do is kind of level that playing field. The public markets, we need to rejuvenate them. I said on last time we were together, I'd like to make IPOs great again. And so we need to do that through addressing issues like excessive disclosure. There's so much detail out there that I think that we can make much more rational litigation issues that scare people away from the public markets, and then finally governance issues as well. And so we can address those things through our regulatory power at the SEC to try to right-size this sort of marketplace.
The other question revolves around liquidity, which is to say that private investments historically have not been liquid. There is this sort of effort to create these semi-liquid instruments. We've talked about BREIT being probably the biggest of them. It's a real estate investment fund, effectively, that's run by Blackstone. Has a semi-liquid piece of it. There was a period of time where it wasn't actually as liquid as it should be. My question is, if you're 20 or 25 years old and you get to own something for 20 or 30 years, you don't need it to be liquid. But by the time you get to retirement, boy, do you need that liquidity. And so if you get to a period of time where, for whatever reason, things aren't liquid, what do? And you create this almost secondary or tertiary market where people are basically liquidating different investments to create that liquidity. Is that a good or bad thing?
Yeah, well, I think that's a good point, and all these issues need to be worked out. And so the one thing, if there are various types of funds, some geared for investors to hit their retirement age or to plan for the future according to various decades of their lives, and then to be able to pass down some of these assets perhaps to the next generation. So through those, working, I think, with the people in the marketplace as they develop ideas for other sorts of funds to come forth, I think they will answer that demand in the marketplace to help solve that liquidity issue. But that is one of the key things. So obviously, you should not invest in a private equity fund just for overnight or short-term type of investment. It's much more of a longer time, and then hopefully it pans out. So, but diversification is key, and that's one thing I think in the retail markets between diversification and addressing fees and addressing the liquidity issues, we will be able to work that out.
Chairman Atkins, just wonder what you think about a lot of companies we've heard from recently that are kind of copying MicroStrategy's technique when it comes to Bitcoin. MicroStrategy was all about Bitcoin and owning that asset. There are a lot of new firms that are doing the same thing with Ethereum now. They want to be the MicroStrategy of the Ethereum realm. We've had a couple of companies that have come on this program and talked about doing that, and I know of several others as well. How do you feel about that? How do you watch it? Some of them use leverage, some of them may not. But what do you think about an area that's seen some pretty big volatility, but also some pretty big gains?
Yeah, well, so similar to Bitcoin, I mean, the SEC has stated informally more than formally that Ether is as not a security. And so, but it's obviously the ETH blockchain is very key component for a lot of other digital currencies. So, it's up to companies to decide where they want to put their money and what sort of strategy they have. Obviously, not for me to tell them, but I think it's encouraging that these sorts of digital assets are being embraced by the marketplace, and I think that provides a good future for development and further innovation in this sector.